The richest man in the world was asked, what will be different in 10 years? He replied that there's an even better question, and it can make you wealthy too.
What's going to change in the next 10 years? And that is an interesting question. It's a very common one. I almost never get the question, what's not going to change in the next 10 years?
We'll explore what that means to you as an investor and as a human being. We're talking about how when I began on day one as a freshly minted and naive real estate investor, what my future and market conditions look like and the lessons you can learn from asking the right questions about your future today. Stick around until the end of the video and you should have lasting insights that can make a real impact in your life. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and 20-year real estate investor. What will be different in 10 years? I mean, no one really knows. Getting around in flying cars, maybe drone-delivered pizza parties? And what about interest rate levels, a recession, or a depression, or an economic boom? And I solemnly pray that it's not AI girlfriends and holographic family dinners. I was recently listening to the richest person in the world, Amazon founder Jeff Bezos, and he said he's often asked what will be different in 10 years. And when he replied that a better question to ask is what will be the same in 10 years, I believe that that is a vital question because you can get more certainty around what will be the same in the future compared to what will be different. 10 plus years ago, people thought that today we'd have a cure for the common cold, and some people thought self-driving cars would be the norm, and you'd have a sophisticated robot working as a maid in your home. Well, that largely didn't come true, so you never know about the future. Well, in real estate then, what will be the same over the next 10 years? It's pretty likely that that's continued inflation, a low housing supply, steady demographic demand, and it's not just immigration, there are more millennials than baby boomers adding to that population. And then there's a fourth certain future factor that's even bigger than those three. I'll get to that later, you'll see why. Within those near certainties, a classic investor axiom is that you can't time the market. You've surely heard that before. You've probably heard it said also that time in the market beats timing the market. And knowing that carefully chosen real estate pays 5 ways at the same time, it's precisely why that's true, the time in the market. Another way that I like to say it is take what you've been given, but not absolutely anything you've been given. Just watch, this ought to be really interesting. Let's compare real estate investor focused factors over 2 decades plus here. When I bought my first property, that modest and seminal fourplex in 2002, there were pros, neutrals, and cons to buying 20 plus years ago in those market conditions, just like there always are. Back then, the pros were a good rent to price ratio, a historically low 6.375% mortgage rate. A neutral was an average vacancy rate back there in 2002. And then the cons to owning back then were low inflation, a high housing supply, and my $295,000 full price offer, which felt high at the time. Gosh, how quaint, the seller wouldn't budge on the price. Another con is that I owned in a small city whose economy wasn't very diversified. I was vulnerable that way, and that's something I didn't even have the wherewithal to think about at the time. Also, I had weak future demographics. Tenants quickly vacated my units because it was easy to get first-time homebuyer loans, a loose lending environment. This is when the acronym NINJA loans came to be. No income, no job or assets. So there they are, the pros, neutrals, and cons of my real estate investing back in 2002. We're going to compare that to today's environment and market conditions soon. But the thing is that I acted back then. I didn't try to time the market. I took what the market gave me and became a profiteer. And this does not mean that you should jump into investing in just any deal. In fact, most properties are not cash flowing moneymakers. Today, investor purchases are breaking records. Investors bought over 26% of low-priced homes in the latest quarter ended. Those lower-priced homes generally make the better rentals. All right, well, in this current environment today, it could very well be better than when I started out, or worse, depending on what you're looking for. Here's what the market is giving investors today. The pros, the upsides, are low vacancy, higher inflation than when I began, but not really high, low housing supply, strong future demographic demand, and dreadful first-time homebuyer affordability, which means more people need to rent, increasing your tenancy duration. More remote tools are available today, from Google Street View to virtual property walkthroughs. All right, those are the pros. What about the neutrals of today's housing market? Well, you've got strict loan underwriting. You often need tax returns, pay stubs, proof of income assets, and a low debt-to-income ratio, but your tenant also needs that to qualify if they want to move out and get their own place. That's why it's neutral. And then finally, we have historically average interest rates today. They're not too far off their long-term average of 7.7%. And then the cons of today's housing market are a lower rent to price ratio, that's a big one, and higher insurance premiums. Okay, so those are the pros, neutrals, and cons of the 2002 real estate investor landscape compared to today's environment. And look, no one knows where any of those factors are going to be in 10 years. Those things right there, nobody. Depending on what you're looking for, appreciation, cash flow, tax benefits, or something else, you can make the case that either one, 2002 or today, is better for you. But as you can see, market conditions for my first property were nowhere close to perfect, and they weren't even ideal. When you select the right property and you're paid 5 ways, real estate can be a rather forgiving asset class. Maybe 3 are paying and 2 aren't in a certain time or cycle. But the gap between the has and have-nots, that is what is really widening at an alarming rate, and it's all fueled by inflation. And owning income property is a generationally proven wealth builder. It's not just an inflation hedge. You can profit from inflation. In fact, when I was brand new to all this, I would attend these real estate investor meetups, and the old timers there, anytime they were asked what they do differently, if they could do it all over again, nearly all of them said, "I wish I would have bought more properties and would have acquired them sooner." Looming uncertainty, that is a permanent condition with no antidote. That has existed every day of your life and every day of my life, and uncertainty will only dissipate and disappear when the world ends, and I'd rather have uncertainty than the apocalypse. So these factors of pros, neutrals, and cons, they constantly shift. There might be more than 20 significant levers. Some of them are constantly moving up and others down. They're always shifting around. And in fact, a life well lived is really about not knowing. The only safe years of your life are the past ones. Live in the question and take what you've been given. And like Jeff Bezos asked, what will be the same in 10 years? For real estate, in addition to those first 3, what else will be the same? It's that people will still need a place to live, and they will pay you rent for providing that. The best time for planting a tree was 20 years ago, and the second best time is today. Invest in what will be the same in 10 years, whether that's inside real estate or outside real estate. It's not flashy, it's fundamental. And with that mindset there, something to act on if you don't really know how to own a rental property, or even if you're a veteran investor, is that what I did for you here is simply explain each step from beginning to end, from your credit score to mortgage pre-approval, inspection, appraisal, and finding a property manager all the way up until your closing day. So that way you'll know how to navigate it and what to expect. It's how to buy your first rental property. You can watch it next right here.